Good morning, and welcome to the Hedge Trade Daily Risk Brief for June 9, 2026. Today's market environment remains constructive over the medium to long term, but more cautious in the short run as major equity indices consolidate near key resistance levels. The S&P 500 continues to reflect a durable multi-stage bull market, supported by bullish weekly moving averages and momentum indicators. However, daily signals show short-term corrective pressure. The index is trading around 7,369, roughly 87 points below resistance at 7,450. And about 63 points above support, near 7,300. This suggests a market that remains structurally positive, but tactically vulnerable to further consolidation. The NASDAQ 100 shows a similar setup, trading around 29,027, after a strong advance of nearly 28% from early 2026 levels. Resistance near 29,500 remains the key upside barrier, while support around 29,000 to 28,500 will be important to monitor. Short-term averages and momentum signals point to digestion near highs, while weekly signals continue to support the broader uptrend, albeit with some signs of exhaustion. Looking at the S&P 500 projection framework, the weekly trend remains robust, with major moving averages aligned to the upside. On the daily time frame, however, short-term bearish pressure is visible, with mixed momentum readings. The projection suggests a possible near-term pullback toward the 7,340 to 7,355 zone around June 10th or 11th, followed by a gradual recovery towards 7,450, and potentially higher into late June and July. This frames the current weakness as a corrective phase within a broader bullish trend. For the NASDAQ, the medium-term framework also remains constructive, but tactical patience is warranted as the index approaches resistance. A decisive move above 29,500 would improve the outlook, while a break below 28,500 would weaken the near-term bullish structure. Volatility remains moderate, with the VIX around 19.87, consistent with a range-bound environment rather than a clear risk-on or risk-off regime. This supports a disciplined portfolio posture, selective engagement on pullbacks, avoidance of aggressive entries near resistance, and close monitoring of momentum, liquidity, and macro catalysts. Small caps, gold, Bitcoin, and USD/JPY remain broadly neutral based on current dashboard signals. Key risks include policy surprises, liquidity tightening, geopolitical developments, crowded positioning near resistance, and shifts in cross-asset correlations. In summary, the market remains constructive, especially across the S&P 500 and NASDAQ 100, but short-term consolidation and mixed momentum argue for patience. The preferred posture is to stay aligned with the broader uptrend while using defined support zones for tactical engagement and avoiding excessive risk near resistance. As always, this briefing is a scenario framework and does not constitute financial advice. Thanks for watching the Hedge Trade Daily Risk Brief, and I'll see you tomorrow.